This entire podcast is AI generated. The conversation, the script, and all three voices you're hearing were created using AI. I'm Milan, and I'm here with Elias and Zane. All right, everyone. Welcome back to the AI in Podcast Roundtable. We've got a packed show today, diving into everything from massive AI funding rounds to the geopolitical ripple effects hitting tech. First up, this SpaceX-Cursor AI deal from April 21st, that's a huge one. I mean, $10 billion for a collaboration and then a $60 billion acquisition option? That's just wild. Especially with Cursor getting access to SpaceX's Colossus supercomputer, it really positions them in developer tools for the xAI IPO. That million H100 equivalent in the Colossus supercomputer is just massive. It's really the core of this deal, isn't it? I mean, Cursor was reportedly bottlenecked by compute, so getting that kind of infrastructure is a game changer for them to build their own models rather than relying on others. It feels like a smart move for both sides, strengthening xAI's offering right before their potential IPO.
That $60 billion option is the real tell here, not the fluff around partnership. SpaceX is basically saying, if Cursor actually helps win developer mindshare, we'll pay up. If not, it's an expensive rental. And that's a very Musk move. And with Bloomberg noting the IPO track is already in motion this month, this feels less like a side quest and more like building the software story that makes the listing believable.
The June IPO target, with that $1.75 trillion valuation, is why the option structure makes so much sense. They're delaying the actual acquisition until after listing, so they don't have to update confidential filings and can use publicly traded stock to finance it. But honestly, the real kicker here is that Cursor was literally mid-close on a $2 billion fundraise this week before SpaceX swooped in. That's not a partnership, that's Musk preempting the competition.
That $2 trillion-ish IPO talk is the part that matters, because once you're trying to sell a valuation that big, every extra revenue story gets stapled on like a roof rack. And the Cursor deal reads exactly like that. Not, look at our partnership, more like, look, we've got a real software wedge. The bigger question is whether that narrative survives contact with actual public market scrutiny, because hype is cheap until the S1 gets real.
Honestly, that software wedge idea for a multi-trillion-dollar valuation just feels flimsy when you look closer. I mean, Bloomberg reported earlier this month, after SpaceX confidentially filed for this massive IPO, that xAI, the very AI layer central to this whole pitch, is actually being rebuilt from scratch because all the original co-founders left in March. How do you staple on a software story when your AI is literally getting torn down and put back together? That just seems like a huge red flag for public market scrutiny, doesn't it?
Honestly, the thing that bothers me isn't even the valuation. It's the story quality. A $50 billion Cursor talk in March and this $60 billion option on April 21st tell you the market's already treating software hype like a tradable asset. But if the AI stack is being rebuilt mid-flight, that's not a moat, that's a renovation. And with SpaceX already in confidential IPO mode this month, public investors are going to ask the ugly question: what's real revenue? And what's just dressed up leverage?
SpaceX is basically admitting it lacks any meaningful AI workforce and business right now. So yeah, the renovation metaphor is spot on. What scares me even more is neither Cursor nor xAI has proprietary models that match Anthropic or OpenAI. The same companies now directly competing with Cursor for developer mindshare. You're basically stapling together two companies that each need the other because they're both losing to the actual leaders.
That workforce gap point is the annoying truth here. If you're short on actual AI talent, you don't have a strategy, you have a shopping list. SpaceX moving employee vesting up in April and still pitching a more than $2 trillion IPO tells you they're trying to keep the machine from rattling apart while they bolt on a software story. And yeah, the Cursor deal is just one symptom of a much bigger scramble, which is why this next infrastructure arms race matters so much.
Honestly, that shopping list idea Zane brought up, it feels more like a desperate scramble to plug holes than a strategic talent acquisition. I mean, Fast Company just reported that all of xAI's original co-founders, besides Musk himself, have now exited, and we're seeing key people still leaving this month. How do you build a multi-trillion-dollar AI story when your core team is literally walking out the door?
Look, the last two co-founders, Manuel Kreuss and Ross Nordin, left on March 27th, so this isn't even news from April. It's already a month old. But the real gut punch is Musk himself admitted on March 13 that xAI's AI coding tools simply did not work, and the whole system needed a rebuild. That's why everyone bailed. You're not plugging holes at that point, you're pouring money into a company whose CEO openly says the product failed.
That March 27th timing matters because it means the rebuild story was already public before the April 21st Cursor deal. This isn't a fresh patch, it's the backdrop. And yeah, if Musk was saying on March 13th the coding tools weren't competitive, then buying the company that just had engineers walk out feels less like conviction and more like panic with better PR. That's why I'm more interested in the next question. Can they buy time fast enough before investors start pricing in the mess?
That's the exact point, Zane. It's not just a rebuild that was public. It's the kind of mess they're in. I mean, the S1 prospectus that went public this week, on April 21st, actually warns that Grok's content has already caused regulatory investigations over non-consensual explicit images. How do you IPO with that kind of risk hanging over your AI layer? It just adds another layer of panic to that expensive shopping list.
That Grok risk line is exactly the headache, because investors can forgive a messy product roadmap, but they don't love regulatory drag on top of a giant valuation pitch. And the weird part is this whole thing is moving in public. SpaceX filed confidentially on April 1st, then started investor site visits by April 15th. So the April 21st Cursor deal and the $2 trillion talk are all part of one very aggressive sell. My take, it's less vision than a frantic bundle of narratives to outrun scrutiny.
The regulatory drag isn't just hypothetical anymore. Investigations launched in Canada, Britain, Brazil, California, and France are all live right now, and NBC found last week that Grok was still generating sexualized images of actors and pop stars. Researchers estimated about 3 million sexualized images, so the guardrails xAI claims it built in January clearly aren't holding. What's wild is you're asking public markets to bet 60 times revenue on a company that might actually lose market access in multiple jurisdictions before the roadshow even ends.
That live investigations point is the real poison pill, because once regulators are poking at the AI layer, the story stops being big ambition and starts looking like compliance debt with rockets attached. And the Cursor deal is smart exactly in the way it's a little scary. It's not just buying a tool, it's trying to own the developer workflow before the IPO scrutiny gets brutal. If they can make that feel like durable software revenue instead of a stunt, fine. But if not, it's just a very expensive way to buy time.
That owning the developer workflow strategy is interesting, Zane, but honestly, it feels like they're stepping into a much messier arena than they realize. I mean, GitHub Copilot just announced this week, on April 20th, they're pausing new signups for their individual plans and tightening usage limits because agentic workflows are crushing their compute. If the market leader is struggling to scale, how quickly can Cursor truly dominate, even with Colossus access?
That Copilot move is the tell, not a footnote. April 20th wasn't some random product tweak. It was GitHub basically saying agentic workflows are eating their lunch on compute. So yeah, Cursor can own a workflow if it's fast and actually useful, but the moat is going to be reliability and unit economics, not vibes. And once Colossus enters the chat, the real fight is who can afford to stay open, not who has the prettiest demo.
GitHub literally said a handful of requests now costs more than the entire monthly plan. So reliability is going to matter way less than whether you can even afford to stay in business at flat rates. Their own documents show weekly Copilot costs doubled since January, and they're actually telling developers to stop using their own fleet command because it burns too many tokens. That's not a product strategy, that's triage.
That April 20 pause is the punchline, honestly. GitHub didn't just tweak pricing. It admitted the agentic stuff is blowing up the old subscription math. And the fleet angle makes it even more obvious. Once you're telling people to use sub-agents carefully because the token burn is nasty, the whole workflow discussion stops being cool product and starts being who can finance the compute. That's where I think this goes next. Not better prompts, just harsher economics.
Yeah, that harsher economics point, Zane. It's not just about better prompts anymore. It really is about who can afford to play the game. I mean, if GitHub Copilot is already pausing new signups because agentic workflows are crushing their compute, then Cursor getting access to SpaceX's Colossus supercomputer on April 21st isn't just a partnership perk. It's an admission ticket to a whole new tier of infrastructure. This isn't just a software wedge. It's a massive compute advantage that could redefine the entire developer tools landscape.
That admission ticket line is right, but it's also the whole trap. If you need Colossus just to make the product economics work, then the moat is basically a power bill with nicer branding. I think Milan's dead on that compute is the game now, but the ugly part is it turns software into CapEx cosplay. And the winners won't just be the smartest teams. They'll be the ones who can keep the burners on.
Cursor literally blogged on April 21st that they've been bottlenecked by compute. So yeah, needing Colossus isn't just about better margins. They couldn't scale at all without it. But the deeper trap is they don't own their models. They're reselling Claude and GPT from the exact companies now building rival dev tools. So every dollar of revenue is basically funding the competition until they can train something proprietary.
That bottleneck is the whole story, and it's why this isn't just better dev tools, it's infrastructure warfare. If Cursor couldn't scale without Colossus, then everybody in agentic AI is staring at the same wall. More Graviton, more Trainium, more bespoke silicon, more CapEx, period. The Meta AWS deal this week is basically the same confession in a different accent. The winner isn't the prettiest model. It's the team that can finance the compute long enough to matter.
That infrastructure warfare idea is absolutely spot on, Zane. And the Meta AWS deal this week with Graviton CPUs, it feels less like a confession and more like an urgent scramble. Hyperscalers are just desperate to gain more control over their infrastructure. We're seeing everyone pushing for custom silicon, not just to reduce NVIDIA reliance, but because the sheer cost of running agentic AI is becoming unsustainable. It's a fight for economic viability.
That's the part people keep skating past. Custom silicon isn't a vanity project. It's survival when agentic workloads torch the old margin math. If Meta's really locking in more Graviton capacity with AWS, that's basically them saying, fine, we'll buy speed and control anywhere we can, because NVIDIA dependence is expensive and brittle. And once every giant is doing that, the real bottleneck isn't the model anymore. It's who can fund the data centers without blowing up the balance sheet.
The balance sheet thing isn't theoretical anymore. Meta just announced Thursday they're cutting 8,000 people, 10% of the workforce. Same week they lock in tens of millions of Graviton cores. They've already committed $48 billion in infrastructure deals with CoreWeave and Nebius just in the last few weeks. So yeah, the old margin model is torched, and they're literally firing people to pay the power bill.
The 8,000 layoff number is the part that tells you this isn't efficiency, it's a reset. If Meta is cutting that deep while still stacking infrastructure bets, then yeah, they're admitting the old operating model is busted, and the CapEx bill is coming due somewhere. The ugly truth is the winners in this phase might look more like finance departments than product teams.
That 8,000 layoff number from Meta isn't just a reset, Zane. It's a flashing red light for the entire tech sector. I mean, we just saw a PitchBook report from April 17th reveal that the pool of distressed U.S. software loans swelled to a record $40.5 billion in March alone. That kind of financial pressure, combined with massive CapEx for AI, screams that the old financing model is completely broken. It's not just big tech, it's the whole ecosystem feeling the squeeze from these harsher economics.
That 8,000 layoff number is the part that makes the flashing red light analogy sting, because it's not a vibe, it's a cash allocation decision. And GitHub saying on April 20th that agentic workflows are changing Copilot's compute demands is the same story in miniature. The software bill is turning into an infrastructure bill fast. So yeah, I buy the warning, but the real danger isn't just stress. It's that a bunch of these companies are still pretending subscription math can survive CapEx reality.
That idea that companies are pretending subscription math can survive CapEx reality, Zane, is exactly what we're seeing play out with Medallia right now. Thoma Bravo basically got wiped out this week, on April 22nd, with lenders taking control as Medallia's debt service climbed far beyond their earnings. It just shows how rapidly these traditional SaaS models are being disrupted, making refinancing nearly impossible when multiples collapse and AI changes the game.
That Medallia deal is the ugliest version of the same problem. When debt service outruns earnings, the whole recurring revenue story turns into a joke. And the April 17th PitchBook note about distressed software loans hitting $40.5 billion just nails it. These aren't isolated failures. They're the maturity wall starting to move. Meanwhile, the AI money is still absurd. Crunchbase had Q1 venture at roughly $300 billion, with AI taking about 80%, which is why this stuff is so distorted.
Medallia is not just illustrating the problem, it's the poster child. 5.1 billion in equity completely wiped out, and as of February, there were 47 billion in distressed software loans across private credit. What's worse is business development companies are trading at their deepest discounts to net asset value in over 5 years. So this isn't one bad bet, it's the entire financing stack breaking down in real time.
That 5.1 billion wipeout is brutal, and Medallia is the exact kind of wreck that tells you this isn't some isolated private equity blooper. When BDCs are at their deepest NAV discounts in years, that's the credit market saying, we don't trust the pipeline. And that bleeds straight into software multiples, IPO timing, all of it. The weird part is the AI money is still flooding in, so you get this insane split screen of boom up top and rot underneath.
It's not an isolated incident at all. Proofpoint is the next shoe to drop, and it's sitting in 6 out of 7 distressed private credit funds right now. That deal floated $4 billion in debt against roughly $150 million in EBITDA, which only works near zero rates, and we're nowhere near that anymore. The sequence is always the same across these deals. Sponsor asks for covenant relief. PIK toggle gets extended. Lenders mark below 80 cents, and at that point, equity's already worthless.
That Proofpoint warning is exactly the kind of sentence that makes credit people go quiet. Because once one sponsor story starts looking like a covenant relief marathon, the whole stack gets repriced. And yeah, the 6 out of 7 funds detail is ugly, but what matters more is the pattern. Distressed software debt is no longer a weird corner case. It's becoming the default explanation for why these growth names can't refinance. Honestly, the next shoe is probably something more boring than people expect, which is why it'll hurt. Pass the mic.
That default explanation for growth names, Zane, it's honestly terrifying because it shows how quickly the entire credit market can seize up on these companies. But what's truly jarring is seeing that rot underneath, while the AI money is just absolutely gushing in. I mean, Q1 2026 saw venture capital funding globally hit nearly $300 billion. And AI alone vacuumed up over 80% of that. It's like we're watching 2 completely different economies right now.
That's the split screen I keep coming back to. $300 billion in Q1, and 80% of it funneled into AI means the top of the market looks euphoric, while the middle gets hollowed out. And honestly, the same week Anthropic was pulling in another huge round and AWS was stuffing more capital into compute, it just reinforces Milan's point. Credit can freeze fast when lenders realize the cash flow story and the CapEx story don't match. That's the squeeze.
That whole cash flow and capex story don't match is why these valuations feel so disconnected, Zane. I mean, we're seeing companies like OpenAI pull in $122 billion in Q1 2026 alone. But you have to ask, is there enough revenue on the horizon to actually justify that kind of money? It feels like throwing billions at a perceived future, but the brutal reality of data center builds and sustained operations needs to be accounted for.
That's the cleanest way to say it. The market is pricing the story, not the cash flow. OpenAI's $122 billion round, Anthropic's $30 billion, and that roughly $297 billion Q1 haul all scream, "We believe the future," while the actual burn on data centers, chips, and power keeps getting shoved farther out the door. I'm with you. If the revenue curve doesn't catch up fast, these valuations start looking less like confidence and more like very expensive faith.
Anthropic hit $30 billion annualized in early April, while OpenAI is sitting at $24 billion. So the expensive faith line is actually getting stress-tested right now in real time. OpenAI is projecting $14 billion in losses for 2026 and won't break even until 2030, while Anthropic expects positive free cash flow next year. That's not hype versus reality, that's two completely different business models colliding, and the market's going to pick a winner way before the capex justifies itself.
That's the part that makes the market look a little drunk. Anthropic at a $30 billion run rate and OpenAI around $24 billion in a business that's being priced like they're already printing money. But if one's at an $800 billion-ish whisper and the other just cleared $852 billion, the real question is whether revenue is outrunning the valuation theater or just giving it more runway. I think that gap stays ugly until one of them proves this isn't all capex gravity and investor mood.
That capex gravity Zane mentioned? That's what really worries me when you overlay it with the geopolitical situation. I mean, Goldman Sachs CEO David Solomon just said this week on April 21st that oil prices could spike to $170 a barrel if the Iran conflict escalates. How do you even begin to justify those massive AI valuations and ongoing data center builds when your foundational energy costs are swinging that wildly? It adds an entirely new, terrifying layer of risk to the whole funding narrative.
That $170 oil scare is the part nobody can handwave away, because capex only looks rational when power is cheap and stable, and that's not guaranteed if the Iran situation flares. The funny not funny bit is we're talking about AI infrastructure like it's just cloud spend, but it's really a bet on energy, geopolitics, and credit all holding together. And with Q1 Venture hitting $300 billion and AI sucking up 80% of it, the money is still charging ahead, even while the floorboards creak.
Look, Brent settled at $105.30 on Friday, not the theoretical $170 Goldman floated. The actual market is already pricing in supply risk without hitting worst-case territory. Brent's jumped over 55% since the war started in late February, so the energy bill is already squeezing data center economics before Solomon's nightmare scenario even shows up. What really scares me is the Strait of Hormuz closure is disrupting 20% of global oil supply, which means every single AI build-out is basically gambling that shipping restarts before their power contracts blow up.
Brent at 105 is already enough to mess with data center math, so I'm not waiting around for the $170 scare to become real before taking it seriously. The 20% through Hormuz is the ugly macro link here. If that lane gets noisy, energy gets pricier, inflation gets stickier, and suddenly all this AI capex has to fight the bond market too. That's the same pressure hitting software debt, just from a different angle. Pass it over.
That Brent at $105 price tag? Zane, it's not just messing with data center math, it's shaking the whole economic foundation these AI valuations are built on. I mean, the IMF just downgraded their global growth forecast for 2026 to 3.1% on April 14th, directly citing the Middle East conflict and rising energy prices. That kind of macro headwind makes justifying these multi-billion-dollar AI investments feel a lot more precarious.
The IMF's own report warns that disappointment over AI-driven productivity is literally listed as one of the downside risks right next to prolonged conflict. So the foundation Milan's talking about is already shaky on purpose. They say agentic AI could boost productivity, but also that markets may be ahead of fundamentals, risking corrections. So even the optimists are hedging their language while pouring $300 billion into the bet.
That IMF warning is the part that should make everybody sit up, because it's basically saying the market might be paying for a productivity miracle that shows up late or not at all. And if the April 14th outlook is already flagging 3.1% global growth plus AI disappointment as a downside risk, then yeah, the whole just add more compute story gets a lot less romantic fast. I think that's the right place to land it. Big bet, real downside, no free lunch. Let's see if the next panel wants to defend the CapEx math.
The IMF's own executive summary this month warns a re-evaluation of profit expectations around AI could trigger an abrupt correction in financial markets, even if productivity gains are realized. So they're not hedging language anymore. They're straight up saying the valuation could collapse before the tech proves itself. And yeah, disappointment over AI-driven productivity is literally listed as a global downside risk right next to prolonged war, which tells you this isn't a sideshow, it's macro canon now. I think the scariest thing is the markets are pricing future productivity that nobody can actually book yet. It's pure faith with a $300 billion quarterly price tag.
That abrupt correction line is the one to tattoo on everyone's forehead, because it's not saying AI is fake. It's saying the cash flows might arrive too late for the price tags people already paid. And honestly, when the IMF is warning in April that profit expectations can snap markets while we're still stuffing another $300 billion into the same bet, that's not optimism. That's leverage wearing a tie. I buy the productivity story. I just don't buy the speed everyone's pretending it'll happen at. That abrupt correction warning is the whole ballgame, because it means the market isn't just overpaying for AI growth, it's overpaying for AI cash flows that are still hostage to energy, rates, and war. If Brent's already punched up and the IMF is saying 3.1% growth with AI disappointment as a downside risk, then these monster rounds look a lot less like conviction and a lot more like leverage in a nicer suit. I buy the tech. I don't buy the timing.
That leverage in a nicer suit idea, Zane, becomes terrifying when you realize just how volatile things are globally. I mean, Iranian authorities seized 2 container vessels in the Strait of Hormuz just this week, on April 22nd. That choke point handles a quarter of global seaborne oil, and traffic is already down to less than 10% of normal volumes. How do you bet hundreds of billions on AI infrastructure when the basic flow of goods and energy is so clearly at risk?
That Hormuz detail is exactly why this stops being macro noise and turns into a real operating risk. Because if traffic is that thin, you're not modeling normal shipping anymore. You're modeling anxiety. I don't think the AI spend stops, but it gets uglier and more selective fast. The money keeps chasing compute, while every extra dollar now has to clear energy, insurance, and geopolitical friction first. That's the mess, and it's not going away next week.
That modeling anxiety Zane mentioned, it's hitting balance sheets right now. We're seeing shipping firms paying up to $4 million just to reroute vessels through the Panama Canal this week because of the Hormuz disruption. That kind of active cost and supply chain rerouting completely scrambles the economic viability for multi-billion-dollar AI infrastructure, turning that leverage in a nicer suit into something far more exposed. That modeling anxiety and the idea of leverage in a nicer suit really hit home for me, because it feels like we're just blindly throwing billions at AI, while the foundational economics are under immense pressure from geopolitics and basic supply chain disruptions. It's a huge gamble. All right, that's all the time we have for this one. A big thank you to Elias and Zane for another incredibly insightful discussion. Until next time, everyone.